Our next guest doesn't see this rally slowing down in November. Fundstrat's Tom Lee. He joins me now. It's good to see you as always. Welcome back.
Great to see you, Scott.
I'm going to take issue like I did last time with a comment that you gave to our producers, Tom. You think it's still the, quote, most hated rally. I just don't know how that still holds water given where we are. I mean, I interview people all day, every day. I've got no bears around.
Well, I mean, maybe some of the bears have gone to hiding, Scott, but because the last time we talked, I wanted to give you some quantitative stats. If you take AAII, which I think is one of the best surveys of high net worth retail investors, it's averaged minus 11.7 this year, negative 11.7. There have only been 3 other times in that survey's 35-year history where the year-to-date average has been negative. It was 1990, 2002, and 2022. So all those times have actually been associated with bear markets. And so sentiment has averaged this year what's consistent with a bear market. So it is the most hated V-shaped rally. Now, there may be some people who say they're no longer bearish, but their P&L doesn't reflect that.
No, that may be fair. Which leads us to the potential of a chase into year end when they realize that what's at stake for them if they're not engaged.
That's right. And we know 80% of fund managers are trailing their respective benchmark this year. It's the worst in almost 25 years. So, and now they're given 2 things to work with. One is that seasonally, November's a good month, so it should be a positive month. And as far as earnings go, and you guys had a conversation about it earlier today, margins have been improving despite tariffs. And so it's showing you that companies, I think, using AI are able to expand profit margins. That's actually a pretty good tailwind because the tariff headwinds are fading, but the benefits from AI margin benefits are still going to grow.
Now, I'm a little surprised, maybe not much, but just because you have a history of liking small caps over the last year or so, but particularly coming off the Fed meeting, where the Fed chair went out of his way to say that December is not a foregone conclusion, and then underscored that with far from it, which obviously, if rates aren't going to go down in the trajectory that you probably thought they would, then small caps are probably not going to perform the way you thought they might.
Yeah. One thing to keep in mind is that, if you look at Fed Fund futures, it's still projecting a cut in December. I think Fed Chair Powell in his statements did give you a window for why it's possible. One is he did acknowledge that inflation's effect from tariffs is less than they expected. And despite a lot of Fed governors talking about inflation widening, that's not the case. When you look at the CPI report in September, it was the highest percentage of components, 54%, that were in outright deflation. So in fact, inflation is falling like a rock. And the second was he acknowledged that rates aren't accommodative. They're just less restrictive. And so in a case where there's falling inflation and if jobs market's weakening, I think that that's a good reason for cuts to happen and in a way that's good for equities.
Yeah, but I mean, we were talking about December probabilities, Tom, before the meeting at like 100%. Now they're down, and some, like, Jeffrey Gundlach, who I interviewed the other day post-Powell, was like, could be 50-50. So maybe that particular trade gets paralyzed, if you will, between now and the next meeting because we just need to see what the Fed's going to do before we become big believers in the small caps.
Yeah. Well, I'm into something that the Fed will not want to do, which is be a little forward-looking. But we have a government shutdown that's continuing that is causing even things like air traffic to slow. And inflation isn't going to be gaining strength in a period like that. So if the Fed was acknowledging inflation's weakening now, I think it's even weaker in December at a time when the labor market is suffering. So I think if someone thinks the odds have dropped because of what the Fed said, I just think the data would support a very opposite picture.
And you still like 7,000 at least between now and the end of the year? I mean, we closed above 6,900 the other day, so we're well on our way, it would appear.
Yeah, that's right. And but it probably makes sense for people to be aware that because October was so strong, we have to consolidate some of those gains in the first half of November. And Mark Newton, our technician, does think that we're going to be entering a period of chop. So 7,000, yes, makes sense, and it's just going to be bumpy in the next couple weeks.
Hey, Tom, have a good weekend.
Possibly.
We'll see you soon. That's Tom
You
Lee
too, Scott.
of Fundstrat. Thank you.